Good evening, students. Welcome back. So, today we are going to start with this next topic, chapter 6. Now, in this topic, we are going to cover three auditing standards. First one is about the subsequent events. Then we'll talk about going concern. I would say a very important area in relation to audit of financial statements and of particular importance considering the environment which is going on, some of the developments which are taking place, okay, and the audit risks which you see for the last few years. And of course, written representation, which is again a very important area as far as the audit closure is concerned. And there's a lot of confusion on this. Okay, so that's why it becomes all the more important. Why? Because many a times you think about the approach which is required to be taken in respect of audit using this written representation, but that may be wrong. Okay, so that will be good to understand in terms of the insights around it, right? So let's begin our discussion with this essay around the subsequent events, essay 560. Now, before we really get on to this auditing standard, essay 560, let's try to understand about the subsequent events. Now, what do you have in case of subsequent events? And how is that required to be considered in relation to the financial statements? And then we'll discuss the audit aspect around it. What is going to be the audit approach? What are the considerations which the auditor will have? What are the courses of action, you can say, which an auditor may plan in respect of the subsequent events? So first of all, let's discuss what is a subsequent event. Now, as the terminology suggests, we are talking about any event which takes place, which occurs after the reporting date. So you can say after the balance sheet date. Okay. So if let's suppose we have this balance sheet date, say as 31st March. Okay. Now in this case, what will happen? The reporting date will be, the subsequent event, or you can say the period to be considered in respect of subsequent events will be after 31st March. Now, in relation to subsequent events, we can also look into the requirements of Ind AS. So we have this Ind AS, you can say the accounting standard, which deals with the requirements related to the subsequent events. So let's quickly understand what are the considerations in relation to subsequent events, and then we'll come back to the audit considerations. Okay. Now, let me just go to the working file. All right, so now if we talk about subsequent events, so let's suppose we are looking at the financial year 25-26, right? This is financial year 25-26, ending on 31st March 2026, right? Now, in this case, the balance sheet date is the cutoff date for our purposes. So now we are talking about any event which arises after 31st March. Okay, now generally, if you look at the financial reporting, so first of all, what we are doing is we are discussing about the financial reporting requirements. So if you pick up any company, will they be able to close their financial statements? Will they be able to finalize their financial statements? Finalization means in terms of complete closure with the audit and all. Will it be possible on the part of any company to get this wrapped up by 31st March? Answer is no, irrespective of the size. Yes or no? Because 31st March is the date when the when the transactions are going on. Accounting cannot be completed. Forget about financial statement, forget about their finalization, forget about their audit. So that's why practically what do you find? There will be a time frame after the balance sheet date within which financial statements will be finalized. So let's suppose for our purposes, we will take 31st May as the date by which the financial statements will be signed off. So you can say this is also the date when the board of directors will approve the financial statements. Means when the board meeting will take place. Okay. And you may also say that this is the date when the audit report is going to be signed off. Right. Now, as far as the accounting standard is concerned, I'm not talking about the audit standard right now. Currently, I'm looking at the financial reporting requirement. Okay. Basis that, what do? You will look at this period. Okay. Why? Because any transaction which occurs during this period up to 31st March 2026, when do you record that? You will record that within the financial year itself. Yes or no? Yeah. So that's why any such transaction is not a matter of our discussion right now. That will always be included, covered within the financial year itself. What is the point of our discussion? Our point of discussion is this period. Starting after 31st March. Now, any event which takes place after 31st March. Now, if you look into the requirements of accounting standard, what does it say? It says that such events could be of two types. Okay. Can you tell me what are those two types of events? Anyone? I can see Prashant. Yeah, Prashant, any thoughts in terms of the financial reporting requirements? What are those types of events? And how do you adjust that? Or how do you consider that as far as the financial reporting is concerned? Any thoughts you'd like to add here? Any thoughts on this? No? Okay, so there you are. So he's saying adjusting event and non-adjusting event. Very good. Now, what do you mean by adjusting event? Any event which takes place during this period. Okay. During this period. But the conditions relating to which existed during the during the reporting year itself, as on the balance sheet date itself. So that's why what do? You will record them. Not on the date of the event. Means you will not record that on this date. When do you record it? You will record it in the financial year itself. Means the reporting year. Okay. Then you have another set of events which are called as non-adjusting events. Now, what are those non-adjusting events? Now, similar to what we discuss in case of adjusting events, if let's suppose any event arises after 31st March, okay, the conditions relating to which do not exist as on the balance sheet date. Okay. So what do? You will not adjust that within the reporting year, but you will give a disclosure for that in the financial statements for the reporting year. Yes or no? Yeah. So in a way, we can say that whether it is adjusting event or non-adjusting event, in some way, those are getting captured within the reporting year itself. Adjusting events are getting recognized, non-adjusting events are getting disclosed. So that's the difference. Now, as an auditor, what do you do? Now comes the point, what do you do as an auditor? I think the requirement is very simple. As an auditor, we can say that our scope of audit will definitely be financial year 25-26. Yes or no? It will be 25-26. But because there are some events which are required to be captured within this reporting year itself, but which may arise up to the date financial statements are not yet approved. So that's why auditor will have to give a consideration to those events also. Means the auditor cannot be limited to 31st March. He will have to go beyond 31st March. Yes or no? He will have to go beyond 31st March. So that's how it will have to be considered, right? Now, how will the auditor do that? So let's try to think about the audit procedures. So in a way, we are saying that the auditor will not only be looking at the transactions of financial year 25-26, but a level of review will be required in respect of the transactions or the events for this subsequent period as well. So no, because any period after 31st March, what do you call it as? That's a subsequent period. Means period subsequent to balance sheet date. Though we are again required to break it into various parts. And we will talk about those parts separately. So how will the auditor do that? So does it mean that the auditor in a way is required to do an audit for these 2 months as well? Full-blown audit? Answer is no. See, in this case, we need to understand the objective. Now, what is the audit objective? See, the audit objective is that any transaction pertaining to, or you can say any transaction which may have an impact on the reporting year, but which may arise during the subsequent period, should be brought to the knowledge of the auditor. So let's think about the audit procedures. Okay, so what could be the audit procedures? So one is, of course, inquiries. Yes or no? It will definitely be inquiries from the management. So the auditor, audit team will go inquire from the management if at all there are any events which have taken place. Auditor should be aware of that. So that will give the auditor clarity around any such event which the management may discuss, which the management may explain. Okay, so that's the first way, and of course the most important way, because auditor should have this discussion with the management. So that's one. What else? See, the auditor will not only be relying or cannot be dependent on the management inquiries only. He needs to go beyond that. So how will he do that? He needs to look at the documents, particularly the important documents during this period, through which the auditor may get insights around any such transactions or events. For example, board minutes. Okay, if there are any meetings of the board of directors, audit committee meetings. So those minutes must be capturing some of the significant transactions, significant events. Well, those must have been discussed over there. So he needs to go through that, right? Third, he needs to do a scrutiny. Now, what do you mean by scrutiny? See, in relation to the transactions which have taken place from say 31st March to 31st May, if the auditor can just flip through maybe some of the important ledgers, okay, some of the journal vouchers for the subsequent period. So there again, auditor can get to understand if some important developments have taken place. Yes or no? Now, it's not going to be easy, and it's not about reviewing each and every ledger, or you can say scrutinizing all the accounts which are there. But on the basis of the audit, on the basis of the understanding of the company, which the auditor would have obtained. Okay, because if you would have reported, sorry, if you would have audited the reporting year, he must be knowing what are the areas, what are the items wherein he may get this. Yes or no? So that's why that is another way to look at some of these transactions, get into some of these transactions through which he can get some sort of clarity. He can get some sort of understanding around these types of transactions, these types of events which may have taken place. Okay, that is again an important area for the auditor to consider, right? Now, some of the important transactions, let's think about it. Some of the important events which may have occurred could be, say, for example, company has received a notice. Okay, let's suppose there's a tax demand pertaining to 25-26 or maybe pertaining to 24-25. Now that demand notice has been received by the company. Now, now this is one area, or you can say one type of event or the development which the auditor may not be aware of. So that's why if you look at the legal and professional charges, which is anyways considered to be an important area in the financial statements, if the auditor would have reviewed that, he would have gone through that. That will give the auditor an understanding about any such development. Of course, see, in this case, a very important role will be played by a couple of things. One is, of course, inquiries, and second is to go through some of the important documents. Further, in relation to this, when the auditor will be interacting with the management, therein the management must also be explaining the auditor about some of the developments which the management might be planning. Okay. So to say that this understanding is required to be obtained, so there are ways to get onto that. It's not going to be so difficult on the part of the auditor to get onto this understanding. At some level, this can always be looked at and understood by the auditor. Right? Now, what is the next thing? Now, the other point is as around the events. Now, if let's suppose there's an event which has taken place and which the management has not considered at all. Now, what is going to be the course of action? See, the course of action in such a case is going to be very simple. Why? Because we are looking at the accounting requirement which the company is supposed to do. And those accounting requirements, we can say, are mandatory on the part of the company. Yes or no? Yeah, so that's a mandatory requirement on the part of the company. So that's why if any such reporting or if any such event has not been captured by the company during the reporting year itself, then what do you call it as? That's an error. Or you can say that's a misstatement. So how will the auditor evaluate that? So the auditor will have to evaluate in the light of any misstatement. Yes or no? If let's suppose if any such event is required to be captured in 25-26, but that's not been captured. So it will have similar reporting implications. It will require similar sort of analysis the way the auditor will do any other misstatement because that's a misstatement. Understood? Right? Now, this is one part to the subsequent events. And this is, you can say, very much in line with what you do under accounting standards also. And of course, if there are any gaps in terms of the compliance with the accounting standard, means if there is a non-compliance with the accounting standard, that will have its own reporting implications and the auditor will have to evaluate that. Okay, so that's one part to it. Now, sometimes what may happen is that there are some developments which have taken place once the audit is closed, once the financial statements are signed off. Yes or no? Now, in respect of those developments, what do you do? Okay, so when you talk about the accounting standard, so accounting standard is dealing with anything which comes up to the date the financial statements are approved. Why? Because anything which arises after the date the financial statements are approved, is that required to be accounted for? Answer is no. Okay, but if let's suppose there are any facts which become known to the auditor after the date of the auditor's report, but before the financial statements are issued, in such a case, what will he do? What is the course of action? Because that is also one of the situations. So let's suppose financial statements will be issued, say, by 15th of June. Yeah, or say 7th of June. Now, what do you do in respect of any fact which comes to the knowledge of the auditor between this 31st May and 7th of June? Yeah, so that is also possible. Yes or no? Now, what will he do? Now, in such a case, see, first of all, the first step is going to be what? The first step will be to assess as to how material is that, how significant is that matter. See, when we are talking about any such matter or any such item which is required to be considered as a part of this auditing standard, see, in relation to a company, there could be various types of events, there could be various types of transactions. Are we talking about all of those transactions, all of those events? No. We are talking about some of the significant areas. Yes or no? Right? So in that case, what do you do as an auditor? Right? So let's look at the working file once again and let's try to assess that. Just give me a minute. I'll open the working file. Now, some of these facts, generally, when we speak about some of these areas, some of these matters, now please understand these are going to be the critical matters. Okay, so let's suppose this is 7th June. Now we are talking about 7th June. Now, actually, what is the nature or what is this matter? So we can say we are talking about a matter which comes to the knowledge of the auditor, which has some impact in relation to which year? Financial year 25-26, means that's the reporting year. Means, let's suppose there is a significant error which exists in the financial statements of reporting year. Auditor has done the audit in a diligent manner, but still he didn't come across. But now, during this period, okay, so now during this period, he gets to know about any such matter. Understood? So now comes the point that what will he do? Okay. So first of all, as a as an immediate requirement, what will he do? He will discuss that with the management. Yes or no? He will discuss that with the management. He will try to find out as to what is the matter, what has taken place, what is the impact, how is it going to impact the financial statements. All of these things means a detailed understanding is something he will want to obtain. And then he will also like to understand what is going to be the approach of the management. Means how is the company going to deal with that? Yes or no? Because what is the thought process of the company? See, there are two ways company may deal with that. So the company may decide that we are going to ignore that. So I'm not saying this matter is immaterial. I'm saying the matter is significant. Still, the company may not want to rectify. So you can say it's a sort of rectification. So the company may want not to do that, because in such a case, auditor will have to decide the course of action. And the other situation is company wants to rectify. So in such a case, what is going to be the repercussion? So financial statements are now corrected, but those are revised as against the one on which the audit report is already issued. Yes or no? So let's try to understand the situation that over here we are saying financial statements are already issued. Audit report on this financial statement is already issued. So if let's suppose you revise them, okay, so if let's suppose you revise them, then what will happen? This audit report is given on the old version. So that's why what will the auditor need? Auditor will have to then discuss this matter with the TCWG as well. Yes or no? Because it's not a small matter. It's not something that the auditor will discuss with the management. Rectification is done and closed. No. You'll have to reach out to TCWG. You'll have to discuss with them as to what is the matter and why it has taken place. Because eventually responsibility of financial statement belongs to whom? It's up to the management. Yes or no? So it's not that the management has not looked at it and only the auditor has looked at it, right? And once this is all done, he will then decide the course of action. Now, a couple of actions he may require. One, he may find there is a need to now revise the audit report. Obviously, yeah. Because if let's suppose the financial statements are revised, so the audit report on the same will have to be revised. Correct. Next, if let's suppose All of this has taken place. And the auditor now wants to revise. So maybe the auditor wants to get into the detail of this matter. Yes or no? Yeah, he may want to get into the details of this matter, right? And he may want to perform some additional procedures, which he will have to decide, because it's not something which the management will decide, it's the auditor will have to decide. And if at all those procedures are required, he will go ahead and perform those procedures. Of course, after discussion with the management. And in respect of the audit report, which is already issued, now this one. Now, because he is revising the audit report, so that's why he'll have to also inform the stakeholders that the audit report which has gone out is revised now. Why? Because the stakeholders should also have this information. They should also have this clarity that now they need to refer the revised one, not the old one. Yes or no? That's going to be important, right? So that's the thing which the stakeholder should also be made aware of. And somewhere in the revised audit report, which is going to then issue, he will have to bring out this aspect. Otherwise, how will any user get to know as to which audit report is final? Correct? So that's something he will have to bring out. And all of these things will be very much dependent on the criticality of the matter. See, some of these matters wherein you will find these types of changes taking place are generally relating to fraud. Okay, generally. Why? Because those are critical matters. And those are the matters which you generally don't come across during the course of audit. Why? Because the nature of those matters is such. See, fraud is difficult to detect. Yes or no? So that's why that's the course of action which the auditor will have to choose. Now, just to quickly flip through this, facts which become known to the auditor after the date of auditor's report, but before the financial statements are issued. So in this case, what will the auditor do? Discuss the matter with management or TCWG. Very important. Determine whether the financial statements need amendment. Inquire how the management intends to address the matter. If the management amends the financial statements, there's no choice. Audit will have to be performed. Why? Because a revised report will have to go out, right? So either he'll amend the audit report to include additional date restricted to the amendment, or provide a new or amended report, including a statement in EOM or other matter parallel, wherein he'll clarify. Okay. However, if the management doesn't amend the financial statements, and if the audit report is not yet provided to the management, then he can just simply modify the opinion. If the audit report has already been provided by the management, he will notify the TCWG not to issue it to third parties. Okay. If still issued, then take appropriate action to prevent reliance on the auditor's report. Right? Now, as regards this next situation, facts that become known to the auditor after the financial statements have been issued. Right? Now, what do you do in this case? after the financial statements have been issued. In this case, here again, if let's suppose there is a thing which has come up, financial statements have been issued. So the similar sort of exercise will be required to be performed by the auditor. Here again, he will have to first of all understand the nature of the matter. Means what is the matter? How significant is that? And of course, how is the management planning to deal with that? Because on the basis of the management plan, management's action, audit procedures will follow. Correct? So he'll like to discuss the matter with the management and of course the TCWG, because these are going to be very critical items. TCWG will definitely get involved, right? Determine whether the financial statements need amendment. Inquire how the management intends to address the matter in the financial statements. Review if the management has taken steps to inform about the situation to everyone in receipt of previously issued financial statements. Now, see, this part is very important. Okay, now this part is very important. Now, why is this important? See, there is a set of financial statement which has already gone to the stakeholders. And most likely an audit report on that has also been given. Okay, now, in that case, what do you do? Ideally, the stakeholder should be informed that this set which they are looking at is going to be revised. Yes or no? Or maybe the one on which they should not rely. Yes or no? So that's why it's important for the stakeholders. Now, who should be doing this? Definitely, it's the management who should be doing this. Why? Because if the stakeholders are not informed, they may be taking decisions on the basis of this incorrect set of financial statements. So that's why, what do you do? That's why you'll have to look into the details of that. Next, if the steps are taken, issue a new or amended report. Definitely. Why? Because if the audit report is going to be issued and the old one has gone out, so somewhere he'll have to clarify in his audit report that this is the amended one, previous one, nobody should be relying on. If the steps are not taken, then take appropriate steps to prevent reliance on the auditor's report. See, stakeholders have received two documents: financial statements and auditor's report. Now, if you talk about the financial statements, that's the document of the management. Who is the owner of that? Management. But audit report is something which belongs to the auditor, right? And the stakeholders will not only be relying on the financial statements, they will be relying on the audited financial statements, isn't it? Because that will give the confidence to the stakeholders. So that's how the stakeholders like to take decisions. Yes or no? So that's why it's important for them. Some of these things are taken care of, right? Now, how will they do that? So if those are informed, if the management doesn't do that, auditor will have to do that. Yeah, because if the auditor has to take some steps, then he needs to reach out to the stakeholders, right? He needs to inform that the report which they are relying on is something which is now getting revised. Okay. Now these are, you can say, some of the areas or the considerations on the part of the auditor. But in respect of this, there is an important part to note. See, when it comes to the events which occur after the date of financial statements up to the date of auditor's report. Okay, so if you talk about that period, so if you go back to our example, if you talk about the period up to 31st May, okay, now let me just go to that working file only. So if you talk about the period up to 31st May, this one, right? See, up to this date, audit is open, financial statements are open. And actually, the auditor is there on the ground, means the audit process is going on, right? Now, what do I mean by that? See, during this period, anything that comes across will definitely be looked at by the auditor, and he will be performing the procedures around it because he is already in the process of performing the audit. Okay, because he is already there and it's his responsibility to look into those events. But when it comes to anything after this, so if you talk about this period, now this is the period during which audit process is not on. Yeah, it's closed, it's shut. So during this period, there is no way auditor can identify any such event, any fact as around this period. How will the auditor get to know about it? It's through the management only. Yes or no? Yeah. So there's a difference between these two. So definitely, if the auditor feels there is a need to audit in respect of this period after 31st May in relation to that fact or the situation which has arisen, he will do that. But the point is, at the first place, he will not be there. He will not be getting to know about it on his own. So if the management doesn't inform, how will he know? He'll not know because his process is not going on. His audit is closed. It's wrapped up. He's done. Right? So that's why there's a difference in between the transactions or the events which are there up to 31st May and which are there after 31st May. Now, please also remember the fact that when I say 31st May, okay, so it's only an example. You should not be thinking that it's the 31st May. 31st May is the date as an example for the purposes of our discussion. Right? Clear on this? Yeah. So this is about subsequent events. Any questions, any doubts around it, if you have, you may let me know. And then we'll move on to the next auditing standard. Manish, Prashant, I understand you are around. If you have any questions, any doubts, please let me know.
No, sir.
No, you're clear? Sure?
Yes, sir.
Okay, great. All right, so now moving further. Next, SA 570, going concern. So, as I just mentioned, that going concern is a very important auditing standard. I'm not saying that the other one or the other auditing standards are not so important. Of course, those are important. But this one is quite important because of the considerations which are involved here. So I'll come to that. I think in the meantime, Manish has a query. So let's try to understand this query. So Manish is asking if the law is permitting to the management for amendment, then what should the auditor do? So as we discussed, if let's suppose management is amending the set of financial statements, okay. So we have a situation wherein a financial statement has gone out, which is now going to be revised. Okay, let's suppose the old version was A and now the new version, let's call it as B, right? Now, auditor has audited which version? A. Audit report is gone out on which version? A. So when the financial statement has changed from A to B, so definitely an audit report will have to be issued on B. Yes or no? So can we consider the audit report on A to be equally valid for B? Answer is no. You can't do that. Correct? So that's why what is going to be the course of action? Auditor will have to issue amended audit report on the amended financial statements. For doing that, he may need to perform some additional audit procedures, which will generally be the case. So generally, he will require some additional audit procedures. Now, what are going to be those audit procedures? What is going to be the extent of that? And in respect of those audit procedures, what all areas he is going to look into? See, that will be dependent on the type of event or the fact which has come to his knowledge. But if you generally talk about some of these matters, see, those are the ones wherein the fraud is detected. So that's why they will involve a significant assessment of that particular matter. And that may also require the auditor to perform maybe additional audit procedures in respect of some of the linked items as well. So it's not that only that particular item. Maybe because of this event, auditor has lost the reliance on the control system. So he may have to revisit the entire audit strategy. Yeah, so it can have huge repercussions. And in terms of the audit approach, in terms of the audit testing, you can say a sort of replanning will generally be done by the auditor. Okay, so it's not about a small mistake has happened for which all of these things are going to be done by the management. No, we are generally not talking about those small matters. Okay, and definitely once the auditor is through in terms of the audit procedures, he will issue the audit report, and this will be the amended audit report. Okay, wherein he will also clarify the previous one you ignore. Yeah, so that's something which you call as other matter paragraph also. Clear? Manish, clear on this? Great. Now, moving on to next auditing standard, going concern. Now, once again, when you talk about this auditing standard, okay, so here again, what do you have? We have one accounting requirement in respect of going concern to begin with. And once you look at the accounting requirement, as a next step, you get onto the audit requirement as well. Okay, so that's why, once again, what do? We will first of all try to understand what is the accounting requirement in relation to going concern. Once we have that clarity, that's when we'll move on to the audit requirements or the audit considerations. Now I'll just open one document for this. So just give me a minute. Now, the first question is, what is going concern? Yes or no? That's the first point for us. Now, any thoughts? I'm sure you are aware of going concern. I'm not talking about the audit consideration, please. First of all, I would like to understand from you, what is going concern? What are the accounting considerations in respect of going concern? Yes. Anyone? Any thoughts in relation to going concern? Great. Manish says, going concern basis of accounting is required to prepare the financial statements by the management. Okay. Anyone else? What do you have in case of going concern? Means when you say going concern, what does it mean? So let's try to understand about going concern. Okay. The going concern actually is a fundamental accounting assumption, right? Now, what do you mean by fundamental accounting assumption? Okay. It means when the financial statements are prepared, it is presumed, means it's a presumption that going concern assumption is appropriate. And that's why it's not disclosed. Because what is there to disclose? When you know it has to be there, that's a presumption. So what is the point of disclosing that? Okay. So you can say it's effectively, or it's like it's a given thing. Okay. So the way we can say is it's a given thing. So you look at the financial statements and you'll say, of course, if these are prepared on the basis of historical cost, then of course, and if there's nothing specified around the going concern, so this assumption is appropriate. It's there, right? So there's nothing to be looked into as to whether it's there or not. Now comes the point that what do you mean by going concern assumption? So let's try to understand that. Let's suppose we are looking at the financial year 25-26 once again. Okay. And we have this reporting date, means the balance sheet date 31st March 2026, for which the financial statements are prepared. So what is the reporting year? 25-26. We are preparing the financial statements for 25-26. Okay. Now, in this case, it is presumed that the company will be able to continue to run its business for at least 12 months. 31st March 2027 means from the balance sheet date for a period of at least 12 months, company will be able to continue. Means the company will not come to an end, company will not shut down. Now, what does it mean? Are we trying to say that the company will be able to run a profitable business? Company will be generating good margins? Is that the thought? Is that the understanding? Answer is no. Maybe the company is loss making. Maybe the company is making losses significantly. Doesn't matter. Okay. Important point is what? That the company should be able to continue despite making losses. If that is the case, then of course you will say that the going concern assumption is appropriate. But if for any reason we will be in a situation that we don't know whether the company will be able to continue or not, then what does it indicate? It indicates company will be wound up, company will be shut down. Okay. And that would indicate a situation that the company's going concern assumption is not appropriate. So therefore, what is the essential requirement on the part of the company? If you say profitability is not essential, I'm not saying the company will not desire that. Of course, company will want to have that. Of course, right? Company will always want to have that. But is that the essential condition? As far as this going concern is concerned, answer is no. So we can say essential consideration will be what? Liquidity, cash. Because the company having funds will be able to continue. But if the company doesn't have funds, that's when it will not be able to continue. So that's going to be the very important consideration. And as we move further, we will talk about it as to why it's going to be an important consideration on the part of the auditor. Okay. Now, next comes the point that in relation to this going concern, wherein we are saying that for at least 12 months it has to be in place. Now, what is going to be the period? Means, do we need to look at it for a period of 5 years, 10 years, 3 years? Means, where do we end? Where do we go? See, generally, if you look at the business, generally, if you look at the company, you will always want this company to continue for a long period of time, no doubt. But as far as the assessment of going concern is concerned, what period you are required to ensure? Means, what is the mandatory requirement? At least 12 months. Okay, so that's how it's required to be looked at. So if somebody says that, okay, for the next 12 months, I can give you the visibility, but beyond that, I can't do that. So will that work? Answer is yes. Though generally it will not happen like this. I'm saying practically it not happen. But if that is the case, will that work? Answer is yes, that will work. There's absolutely no problem in doing that. Okay. Now, in this case, if let's suppose we are saying going concern assumption is appropriate. Okay. That's a fundamental accounting assumption, basis which financial statements are prepared. So that's good. What if the going concern assumption is not appropriate? Because we can also have that other situation. Yes or no? So let's think about it and let's try to understand as to what is going to happen to the company in such a scenario and how is that going to have an impact in relation to the financial statements. Because eventually it comes down to the financial reporting only, means the financial statements only. Yes or no? So that's what the auditor is also required to consider. Correct? So now, in relation to the going concern assumption, if let's suppose we are saying that the company is saying or we have this assessment that the going concern assumption is not appropriate. So what does it indicate? That somewhere during this period, it will shut down. Yes or no? Yeah, somewhere during the period of next 12 months, it will shut down. Means the company will be wound up. It will come to an end. So that's why the standard requires in such a scenario when you know that within the next 12 months, company is not going to continue. So that's why what should you do? You should do the accounting of liquidation as on 31st March 2026 itself. So when the company is wound up, when the company is liquidated, what do? All the assets and liabilities will get liquidated, yeah, which will take a period of time. So I'm not saying that we are going to liquidate that, but when the balance sheet is prepared and when they are appearing at historical cost, so will that be appropriate? Answer is no. Answer is no. So what should the company do? Like Machine Manish just mentioned, bring them to their realizable value. All the balance sheet items, all the assets, all the liabilities will have to be bring down to their liquidated values. So instead of historical cost, what do? You bring them to their liquidated values, realizable values. So that means it's going to have a huge impact on the financial statements. Why? Because this entire balance sheet will change, the P&L will be impacted significantly. Correct? So this is the accounting change which will arise in case the going concern assumption is not considered to be appropriate. Yes or no? Right? So now in this case, the next question arises that accounting requirement of going concern is understood. Okay. So if let's suppose one has to look into it. So what should the company do? What should the auditor do? So as a first step, when you talk about the financial statements, right? So whose responsibility is that? Company. It's the company which has to ensure that the financial statements which are getting prepared are in line with the accounting standards. They reflect true and fair view. So that's why the consideration around going concern and reporting, presenting the financial statements in line with that. Who will do this assessment? First of all, it has to be done by the management of the company. Yes or no? Right? Now comes the question that it's fine that the management needs to consider that, but how do they consider? Means what is it that they do? How do they make the assessment? So let's look at the factors they will consider. They will have to evaluate the nature of the business, the condition which is going on. See, many a time some of the policies may change, which may have a huge impact on the business. Let's suppose government has brought a policy due to which the nature of business the company is into, it will not be able to survive. Yes or no? Maybe the technology the company was using has changed. Okay. And the developments which are going on are quite significant. So some of these factors, who will need to take care of that? It's the management, right? Many a times what may happen is, say there are regulatory demands which can again have a huge impact on the company. Many a times what do you find? A company has received a demand from a regulator, and the demand amount is such that the entire company will be wiped out. Yeah, so you come across those situations practically. Now the management needs to evaluate that impact of such, you can say, sort of actions of the regulators at times. Who needs to evaluate that? It's the management who needs to do that. So we are not saying that if, let's suppose, the management will come across any such thing, so management will just switch to reporting the balance sheet at realizable value. No. So it's only about assessing two things: whether the going concern assumption is appropriate or not. That's it. Yeah. So if the assessment is done and the management is fine with that, there's absolutely no problem. But the important part is assessment is required. So the management cannot ignore the assessment. Means that has to be done. Understood? That's a mandate. So the management cannot say that this assessment is not done. That will be inappropriate on the part of the management. Right? Now, once the management has done the assessment, management has looked into all of those factors, and the management has produced the financial statements. Okay. And now the audit has started. So now what is it that the auditor needs to do? So now it comes to the auditor. So now we need to look at it from the perspective of the auditor. What are the considerations auditor will need to have? See, we can just first of all understand this in a very simple manner. What is that? Auditor should discuss, evaluate, assessment of the management. Why? Because I keep saying that auditor is simply required to check whether the accounting, financial reporting has been done in an appropriate manner or not. Okay. So that's why whatever management has done, auditor needs to check whether the management has done that or not, and whether the management or the way the management was required to do that. Okay, so one is the way management has done, the way management was required to do that, whether it's been done in that manner, means whether it's been done in an appropriate manner or not. Yeah. So in a very simple layman term, we can say that as far as the auditor is concerned. But now we need to get into the details of that. As an auditor, what do you do? See, it's a risk, no doubt. And it's a significant risk at times. But please understand that whether it's a risk means it's a significant risk or it's not a significant risk will be determined by the auditor, will have to be assessed by the auditor. Means auditor will have to do this risk assessment. Okay. And what will be the basis of doing that? Of course, some of the factors which the management was required to consider, auditor should also be considering those factors. Auditor will also be evaluating those factors in terms of their impact on the industry, on the company. How significant will that be? So you can say that's an independent evaluation. So one is, of course, evaluation of the management. Auditor will definitely go and check that, but the auditor also needs to evaluate that in an independent manner, right? He needs to do that in an independent manner, right? Now, what are those considerations which the auditor will have? See, whenever the management will make the assessment, definitely some judgments will be involved. Yes or no? Definitely some judgments will be involved. Because it's not a matter over which you can say it's a right or wrong thing. See, it's not something which is black and white. Anything which requires assessment based on some factors will require a lot of judgment. Okay, so evaluation of that judgment and the judgment of the auditor will have to be considered. That will have to be brought into the assessment. Why? Because that will also have an impact on whether the assessment which the management has done is appropriate or not. See, in this case, some of the factors which the auditor may consider. Now, what are those? Or you can say, what are those factors basis which auditor may get to know as to whether the entity is in a situation wherein the going concern assumption may not be appropriate. So let's try to look at those examples. Some examples of events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. So what are those factors? First, and a very important factor, which you can just easily evaluate. So if you look at the financial statements of the company, you can easily evaluate that. If, let's suppose, the company is running into losses, let's suppose for the past few years, and the losses are such that the net worth of the company is significantly eroded or fully eroded. Yeah. So you may be thinking, but just now we discussed that it's not about making profits, no doubt. But actually, we need to understand that the company in a way is moving in that direction or not. Right? But in this case, the important consideration will be around the cash losses. Whether the company is incurring cash losses or not. So if the company is incurring significant losses, which is also eroding its net worth, definitely the company is going to have cash losses. Yes or no? Next, negative operating cash flows. See, for any business, cash flow is a very important factor. For which, what do? You will go to the cash flow statement. So you may be thinking that, does it mean we need to review the cash flow statement? Answer is yes, no doubt. Because we are also talking about the liquidity. So where do you get to see that? Of course, the cash flow. But even if you talk about the cash flow statement, for a company, it's not necessary that the cash flows will always be positive. They may be negative. But as far as the operating cash flows are concerned, it's a healthy sign on the part of the entity if their operating cash flows are positive. See, on an overall basis, what do you have? You'll have operating cash flows, investing cash flows, financing cash flows. Yeah, so those three categories are there. So the cash flows from operating activities indicate whether the business is able to generate the cash flows or not. On an overall basis, if let's suppose due to finance cost, the company is losing out on the cash flows. Maybe the company is making significant investment, so that's why it's running short of cash flows. That can be understood. Why? Because those could be the considerations which may lead to expansion or which may require the company to maybe look into some of the factors like reduction in the debt, etc. But if let's suppose the core business of the company has not been able to generate cash, then that's a very unhealthy sign in relation to its business, right? That's not considered to be a healthy sign. Yeah, so that's why what is an important factor? Whether the operating cash flows are positive. Let's suppose you come across negative operating cash flows. So, as an auditor, that should be a worrying factor. Now, because we are talking about liquidity and we are looking at next 12 months. Okay. So, we are looking at 12 months from the balance sheet date. Yes or no? We are looking at the cash flows from the balance sheet date, right? So in this case, what if the current liabilities of the company are higher or significantly higher than the current assets? That poses a question mark. Why? Because in relation to the current liabilities, what do we understand? Those are required to be settled within next 12 months. So how will you settle that? From current assets. So you'll not look at the non-current assets. You'll not sell PPE to meet the short-term liabilities. Yes or no? Right? So where do you meet these requirements from? From the current assets. So that's why current ratio, again, a very important consideration on the part of the auditor. Right? So that's again a very important criteria. So you can say that these are some of the audit procedures, these are some of the audit considerations basis which auditor will decide, basis which auditor will do the assessment, means whether the going concern assumption is appropriate or not. Similarly, we have other factors also. If you come across a situation that the short-term borrowings are used to finance long-term assets, if let's suppose there's a withdrawal of financial support by the creditors, there's a delay in repayment of loans. So why there is a delay? Company is having a cash crunch. Yes or no? So that's why you see the delays. If let's suppose there are adverse key financial ratios, right? If there are substantial operating losses, right? Inability to pay creditors on the due dates. These are all indicators of what? Cash crunch. Why? Because the cash is important. Because what do you need? You need the funds to run the company for next 12 months. So this is an important consideration which the auditor will have as far as the going concern assumption is concerned. Now, let's look at the operating factors. If let's suppose company has lost the KMPs and they do not have the replacement, means the KMP is moved out. So do you have the replacement? Do you have the employees or the senior management moving out? Yes, of course. Okay, so that is a normal process. But what if they are moving out and the company doesn't have the replacement? So that indicates that there are some concerns. Okay, or you can say that's one of the factors which the auditor needs to consider. Let's suppose the competition has increased significantly, and which poses a question mark in terms of sustainability of the business of the entity. Let's suppose management intends to liquidate the entity. So the intent of the management is such. At times they may have that, okay, shortage of important supplies, loss of major market key customers. Again, some of these factors will also be evaluated. Okay, so once you come across those factors, that's when you will do the assessment. Now, many a times, what do you find? Say the company will have a loan, right? Let's suppose currently the company has a cash crunch, so company doesn't have the funds to survive. But the management says that within next 6 months, a loan will be approved. Okay, basis which the company will be able to generate the funds. Okay, so that's what the auditor needs to evaluate. Means, is the company having a signed contract or are they only having discussions with the bankers? Because if the discussions are going on, you don't know whether the loan will be sanctioned or not. But if let's suppose there are signed contracts in place, then definitely it's all about disbursement. The auditor may also want to get into the interim period financial statements. See, a very important working file, or you can say a very important basis for the evaluation of going concern happens to be what? Projections. Because auditor is looking at the future period. So does it mean we are not auditing the reporting year, we are reporting the future year? No. But in relation to the reporting year, this important consideration is there. So that's why the auditor will have to get into the projections which the management will have to produce. And we are talking about the cash flow projections. Okay, so we are not talking about what are going to be the profits for the next 5 years. No, we are talking about what all cash flows will be generated over a period of next 5 years. Why? Because that will help the company to survive. That will become the basis for the company to survive, because without that, company will not be able to survive. So that's the important consideration which the company needs to have, right? Now, in terms of projections, so let's try to understand around the projections, some of these factors which the auditor needs to have in place. See, projections, if let's suppose you happen to be the auditor, you go ask the management. So it's very simple for the management to produce a set of financial statements. Because what are projections? So you can say again, it's an Excel working file, right? So if let's suppose you happen to be the auditor, okay? So what do? You will go ask the management, right? And the management will produce projections to you. And you get to see a very rosy picture in the projections. Yes or no? Possible. Answer is yes, very much possible. So now comes the question that if you come across those projections, can you just simply rely on those projections as it is? Answer is again no. See, this is a very important set of information that the auditor will obtain. no doubt about it. But in respect of this important information, the most important part is what? Assumptions. Because if the projections are there, so we are not talking about the actual information. Yes or no? So how will the management prepare that? Basis the assumptions. So what is therefore required on the part of the auditor? First and foremost, to understand these assumptions. Means whether these assumptions look reasonable or not. Yes or no? Auditor will have to get into those workings. Auditor will also have to understand at what level these projections have been approved. Because it shouldn't happen that the accountant has prepared this Excel file and produced to the auditor. This must have been looked at by TCWG. And generally, what is it the auditor will ask for? Board approved. It has to be approved by the board of directors. Further, the information which is there in the projections should also be backed up. Yes or no? This should be backed up by evidence. So we are not saying each and every information therein will require some sort of evidence, but of course, if the management is taking some assumptions, let's suppose they are saying in the next 5 years we are going to get profits, we are going to get some sales number, we are going to generate some funds. So what is the basis of the management saying that? So see, it's a very detailed exercise and it's a very critical procedure on the part of the auditor. Why? Because you can just understand the impact. See, it's going to have a very critical impact. Why? Because if let's suppose going concern assumption is appropriate, and if let's suppose that is not appropriate, what is going to be the impact? The way the financial statements are prepared are going to completely change. Yes or no? So that's why it's a very important area. And these days in particular, when you come across a lot of companies which are getting into restructuring, a lot of companies which are going into IBC. So what do you find? Liquidity constraints, going concern issues around them. Yes or no? Yeah. So therein, a thorough audit in relation to some of these areas, consideration of some of these factors become very, very important on the part of the auditor. And this happens to be one of those areas. Let's suppose if you look at the audit files from a regulatory perspective as well. So this plays a very important role. This is a very critical factor which the reviewers are also interested in. Okay, so that's why what will he do? He will analyze, discuss the cash flows, profits, other relevant forecasts with the management. Okay, some of the loans arrangements which are there, auditor will get into the details. Minutes of the board meetings. Again, a very important area because therein some of these uh, some of these assumptions would have been discussed. Some of these aspects would have been covered. Inquiry of the entity's legal counsel. Why is that relevant? Why is that important? To find out if there are some significant litigations going on, which the management may not have informed the auditor about. So that's how the auditor will get to know about it. Evaluating the entity's plans to deal with unfulfilled customer auditors. Obtaining and reviewing reports of regulatory actions, if there are any. Now, that is again very important because there could be some critical assessment, right? There could be some demands, there could be some regulatory actions which the auditor needs to assess, which the auditor needs to decide. Okay. Now, as around that projection, some of those assumptions, auditor needs to obtain sufficient appropriate audit evidence. What is SAAE? Sufficient appropriate audit evidence. As around what? As around the assumptions of the management, assessment of the management. Because if that is done, that's what the auditor is now going to look into. Of course, he will apply his judgment, but some of those factors he'll have to consider. Okay, basis which he will get on to the conclusions. Now, in this case, sometimes what may happen is going concern assumption may be appropriate, but there's a term that you call as material uncertainty. So that may exist. So now what we will do is we'll just try to get into that situation as well. Okay, but I think before we get on to that, we can take a break. Yeah, so we can take a break now. Any questions, any doubts before that, if you have, please let me know. Any questions? No? Sure? All right, so let's take a break and then we'll continue. Yeah, sure, we can take a break now. Sure. Move further. Okay, so talking about material uncertainty. Now, sometimes what may happen is going concern assumption is appropriate. Okay, but a material uncertainty exists in relation to that going concern. So we are not saying that going concern assumption is not appropriate, right? So you can say it's the second stage. See, what is the worst one when you are saying that the going concern assumption is inappropriate? But if let's suppose that is appropriate, but still there's a material uncertainty attached around it. So you can say there's a significant concern around it. Now, when do you have that? Once again, when you have similar sort of factors in relation to the liquidity crunch, in relation to the profitability, yeah, that may cast a significant doubt on the entity's ability to continue as a going concern. Now, in that case, a couple of situations may arise. Okay, why? Because depending on the situation the auditor will be into, means depending on what the auditor will be planning to do. So let's look at those situations. So we are talking about this situation first of all. So let's suppose going concern assumption is appropriate. Fine. But material uncertainty exists. See, one situation is going concern assumption is appropriate, material uncertainty is not there. So in that case, there is no problem at all. Okay. So we are not talking about it. Why? Because in that case, do we have any reporting implications? Answer is no. There are no reporting implications. But if the material uncertainty exists, then the management should disclose about it in their financial statements. So what will the management disclose? How will they disclose? Generally, what do? They explain about it, that the company has been running into losses due to some of the factors. So they will generally explain that in detail. Why? Because the management also wants to give the perspective at times to the stakeholders. Because through that note, which goes into the financial statements, management in a way wants to provide the details that many a times that the loss which has been going on could be for a short term, could be some of the factors which have already taken place, and that's why the profitability is expected to improve. Means that sort of messaging is tried to be passed on. So we are not saying that the management will be discussing about the future, but the way that is communicated becomes important. Why? Because the details around it will help the stakeholders to decide, to assess. Okay. Now, if let's suppose management gives the disclosure, okay, so it's an appropriate disclosure wherein the management is covering the complete details. So we are not talking about any recognition or measurement. It's only a disclosure. So where will they do? In the notes to accounts. So you can say it's an explanation, a detailed explanation. In such a case, auditor will include a para in his audit report, a separate para. So it is similar to emphasis of matter. Please understand, it's not emphasis of matter, it's similar to emphasis of matter. Why? Because auditor, through this para in his audit report, will highlight this disclosure. So what is the objective of the auditor? So he's saying that the financial statements are free from material misstatements. Okay, so there is no material misstatement there. But as far as the status of the entity is concerned, there could be a concern which the stakeholders should be aware of. So idea is to make them aware of that concern. Okay. So if they clarity around it, if they get to know about that concern, that's good enough. Okay. So that's the objective of the auditor in such a case. So that's why he would, in a way, highlight this disclosure. So that's why what will he do? He will give a reference of this disclosure. And this para is very commonly called as MUGC para. See, each and every report will not have that. It's similar to emphasis of matter. As and when it is required, it will be included. So when you look at audit report, opinion para, basis for opinion, it will always be there. But this MUGC para will be there if it is applicable. If it is not applicable to the entity, it will not be there. Understood? So that's why if you come across some of the entities, let's suppose you are reading the annual report and you go through the audit report, financial statements of a company, and you don't find this para. So don't get confused. So that would mean it's not applicable, it's not, that's why it's not there. So which also implies that this para will only be included if it's applicable. So we'll not give the para and say it's not applicable. Why? Because it's not a checklist. Understood? It's not a checklist which the auditor needs to include and say yes or no. No, that's not the approach. Clear? Next. See, another situation is, let's suppose the company doesn't want to give the disclosure or gives the disclosure, but that is inadequate. Now, who will decide that? Whether it's adequate or inadequate? Now we are talking about the consideration of the auditor. His judgment means he needs to evaluate that. If he believes the disclosure is given, it's inadequate, or if the disclosure is not given. So then we are talking about a situation that the financial statements have a concern, right? Which has not been brought to the notice of the stakeholders. So can we say it's a misstatement? Answer is yes. The question arises whether it is material. Answer is again yes. Why? Because now we are talking about a situation which is very important for the stakeholders. And in this case, what is the nature of the misstatement? Disclosure deficiency. Now, somebody may think that what if the explanation is not given, or what if the explanation is improper? So can we say that it can become a material misstatement? Answer is yes. See, when you talk about misstatement doesn't mean that passing the wrong accounting entry or not passing an accounting entry. It means anything in relation to recognition, measurement, presentation, or disclosure in the financial statements. Anything in relation to that. Okay. So that's why if the situation is involving disclosure deficiency, if it's about a disclosure deficiency, it would mean the auditor will now be looking at the modification in the auditor's report. So the modification will definitely be there. So the moment you say material misstatement, modification will arise. The only point is he will have to assess whether the material misstatement has a pervasive impact. If yes, it will get on to adverse opinion. If no, it will come down to qualified opinion. Okay. Yeah. So that's why we may have two situations in relation to material uncertainty. Now, let's talk about the worst scenario. Now, that is also possible. Now, what is the worst scenario which is possible? Worst scenario is wherein the going concern assumption is inappropriate and the management has not incorporated the impact of that inappropriateness of going concern in the financial statement. So what do you mean by that? Means the management has not brought the balance sheet or the items of the balance sheet at realizable value. The management is continuing with the same approach, the one they will do under situation when the going concern assumption is appropriate. So in that case, we are talking about a material misstatement which flows to entire set of financial statements. Why? Because this entire balance sheet is wrong, P&L is wrong, yes or no, which will have its implications around the entire set. So definitely it will invite a modification. And can it be limited to qualification? Answer is no. It's a severe situation. So that's why it will always be an adverse opinion. Okay, clear on this, right? So as around the going concern assumption, we have talked about three situations. A, when the going concern assumption is inappropriate. So what do? Adverse opinion. B, going concern assumption is appropriate, but material uncertainty exists. Now, in this case, either the management will give the disclosure, B1, then the auditor will not do the modification. He will not give any modification. He will only highlight that para. That's what you call as B1. Otherwise, he will have to go down to the modification, which is B2. Understood? Right? Clear on this? Any questions on this? See, this standard, I would say, is very important. And this part, this flowchart that you look at, I would say summarizes some of those requirements. So that's why any questions, any doubts, if you have, please ask me. Yes. Are you clear on this? Yeah, sure. Okay. All right. So let's move further. Going concern as an assessment is to be made at standalone level or consolidated level. What do you think? Yes, over to you. What do you think, at what level you will do this assessment? Quickly, over to you. At what level you do this assessment? See, the nature of this assessment is such that you will always be doing this at standalone level. Yes or no? Yeah. Next, let's look at this case scenario. ABC Limited is a manufacturing company. Okay, it is continuously making good amount of profits and has high dividend payout ratio. In June 23, subsequent to the year end, so that means we are looking at 22-23, High Court has imposed significant amount of penalty on the company due to non-compliance of environmental norms. Now the impact of penalty is what? It will erode the entire net worth of the company. Okay, so it's a significant impact, right? Entire net worth of the company will be eroded due to this. The management has filed an appeal with the Supreme Court and is confident of favorable order backed by a legal opinion. Right? So means the matter is now under litigation. In this case, if let's suppose you are the auditor for the reporting year 22-23, should you take into considerations event which happened after the balance sheet date 31st March 23 for the assessment of going concern? What do you think? Should you be doing that? Yes or no? Tell me. Should you
Yes,
be
sir.
doing that?
Yes,
Yes.
sir.
So why do you do that? Tell me. Tell me, why do you do that?
Because the conditions existed on the date of the balance sheet, and its impact is on the balance sheet, which is significant.
Correct. Because this can have a huge impact on the financial statements of the company. So going concern assessment is something which you will always be doing, right? So it's not something that you will say that it's an adjusting or non-adjusting, even if it's non-adjusting, which is resulting into a going concern assumption becoming inappropriate. That will also be required to be incorporated in the reporting year itself. So let's take an example for this. Say 25-26 is the reporting year. Okay. Let's suppose 31st May is the date by which financial statements will be approved. Right? Let's suppose fire took place on 25th of May 2026. Now, will you say that this fire which has taken place on 25th May 2026 is an adjusting event? Answer is no. It's a non-adjusting event. But in this case, what has happened? Due to this fire, the destruction is such that the company will not be able to continue as a going concern anymore. In this case, because the nature and the impact of the event is such that it is going to impact the going concern assumption. So, despite this event being non-adjusting in nature, you will require to adjust that in the reporting year itself. Okay. Yeah. So that's why if you look at this scenario, if let's suppose the impact is going to be there on the going concern assumption becoming inappropriate, so you will have to evaluate that. Why? Because this is going to impact the reporting year financial statements, not in terms of disclosure, but in terms of recognition and measurement. So we are not saying that its disclosure will be required. Of course, that is no doubt required, but it's required to be adjusted in the financial statements of 25-26. Understood? What would your conclusion be and why? Of course, I think we discussed about it. What would be the reporting implication if the management has adequately disclosed the matter in the financial statements? I think we just now discussed this. If the management has appropriately covered that, okay, so there's a proper explanation which has gone out. So what do? You will say it's fine. I'll not do any sort of modification. So, okay, why? Because the financial statements reflect a true and fair view. But there's a matter which I want to bring to the knowledge of stakeholders, which I want to highlight that they should be aware of that. As of now, financial statements are good, but there's a concern which they need to be made aware of. So that's why what do? You will include MUGC para, right? And in that para, you will specify my opinion is not modified in respect of this matter. Something that you do under CAM, something that you do under emphasis of matter, something that you do under other matter paragraph. Okay, it's similar to that, right? So with this, we are through on this auditing standard. I would say a very important one for the purposes of our discussion. Now, moving further, before we move on to some more questions, I'll just pick up this next auditing standard on return representation as well. SA 580. Okay. Now, if you talk about this auditing standard, so you can say there are a lot of confusions around it. And because of those confusions, sometimes you come across situations wherein the audit is completed, but there are deficiencies in relation to the audit procedures altogether. Okay, so we'll try to understand that with the help of some examples. Let's first of all understand what a written representation is. So this is very commonly called as rep letter or MRL. So we are talking about management representation letter. Means letter of representation given by the management of the company. And who is giving this letter to whom? So it's a letter which goes out from the company to the auditor. Okay. Now, let's try to understand some of the aspects around this rep letter. See, now we are talking about a letter. So let's suppose there is a company ABC Limited. Its audit is going on. And who is the auditor? PQR and Company is the auditor. Okay. So once the audit is completed, wherein the auditor would have performed various procedures. And what are those procedures? We don't need to get into that. Of course, there are a lot of procedures auditor will be performing. So we are not getting into the details of those procedures. Not really relevant for us. And before the audit procedures, management would have prepared the financial statements, presented that. Why? Because it's the responsibility of ABC. Yes or no? So let's suppose we are given a set of financial statements. Who has prepared that? Management. Whether it's audited? Yes. Who has audited that? PQR. Now, at the time of conclusion of audit, means when it's wrapped up, when we are through, when you are sort of in the process of issuing the audit report as an auditor, you are asking the management in writing that the financial statements which they have prepared, as to what's the basis of doing that. Okay, so it's something like, let's suppose a person has done the work, person has also explained. So as an auditor, what do? You go ask a lot of queries. Yes or no? You will make a lot of inquiries. You'll also be looking at various documents on the basis of the understanding that you would have obtained, right? And then, basis all of that, you would be making the conclusions, right? And of course, you'll form an opinion and you will give this in writing to the management. Now, for this purpose, before you issue the opinion, you are also asking the management that something which you have explained to me. Okay. Or something which you have used in terms of the policies, procedures, adjustments in relation to the financial statements prepared by you. Give a letter and write all of those points in that letter and issue that letter to me. So in a way, now you are asking the company's management to give all of that in writing. So are we talking about all the working files, all the explanations? No. It's all about the preparation of the financial statements, means something which has become the basis for the preparation presentation of the financial statement. So that's what the management will include in that letter. So we can now easily understand that we are actually talking about a letter which is being issued by management. So that's why it has to be on the letterhead of the company. Okay, right? And in that letter, what will the company cover? Everything around the financial statements. Now, why is that required? Because it acts as an evidence. Yeah, but there's a problem now. What is the problem? Let's suppose management has prepared an MRL. Let's suppose management has written this MRL. Okay, and it's been signed off. Right? It's been signed off by the management. So management is saying anything you require, anything we have done in the financial statements. If let's suppose you talk about revenue recognition, if you talk about inventory valuation, if you talk about say revaluation of PP, we have mentioned that. Okay, we have explained that in the MRL, and if you require something in detail, we have also written that in detail. Okay. Now comes the point that when we talk about MRL, what is that? See, it's a top up. Actually, it's a top up. It's a top up of what? It's a top up of the procedures which the auditor would have performed. And once the auditor is through with that, he is asking for this written letter from the company. But many a times, what happens? Let's suppose you talk about PPE. See, the auditor is asking for some information in relation to PPE, but the management doesn't have that. Or maybe the management has that, but the management doesn't want to provide to the auditor. And the management says that take our words, what we are saying is absolutely correct. And if you don't believe us, we are happy to write that in writing in the MRL. Okay. Now, many a times you come across these situations. So, if let's suppose you have been the auditor, you will be able to relate to some of these points. In such a case, the question arises that can the auditor move on, or can he just work on that approach? Will that be considered to be appropriate? Answer is no. Why is that so? Because MRL is not a conclusive evidence. Now, that's the most important point. One needs to understand the fact that it's something in addition to what the auditor has done. So, if let's suppose the procedures on audit which the auditor would have planned are completed to the satisfaction of the auditor, means auditor has obtained sufficient appropriate audit evidence, that's when the auditor is also asking for the MRL in relation to PP. So you can say it's a top up to the sufficient appropriate audit evidence which the auditor would have obtained through the audit procedures. That's why MRL should not be considered as a substitute to the audit procedures or to any of the audit procedures, which is at times done by the auditors. So if that is done, what would happen? That would mean that the auditor has not obtained the sufficient appropriate audit evidence. Why? Because if the auditor only relies on this is not conclusive. This is not conclusive. Okay. So if something is not conclusive, how can the auditor just go and rely on that? Will that be considered to be appropriate? Answer is no. Okay, that will not be considered to be appropriate. So that is not conclusive. Yeah. So that's why if you come across any such situation, we must understand the fact that it's something which is obtained once the audit procedures are completed, once the entire audit is done, once we are through with that in all respects. That's when you get on to that. Okay, that's when you will look into this sort of document. Now, when do you obtain this document? Now, the next question arises, when would the auditor obtain this? See, this document is obtained generally. There are three documents which are signed off on the same day or near around that: financial statements, audit report, and the MRL. So, when do you obtain that? On the day audit report is issued. Okay, yeah. So, is it possible that you get this signed off as of 31st March? No, because that's not the objective. And why is that so? Because when it comes to the financial statements, you are not only looking at 31st March. Please understand, you are also looking at the subsequent events. So that's why somewhere in this MRL, they will also be specifying that. Why? Because to look into the subsequent events is also the responsibility of the management. Yes or no? So that's why each and every aspect as around the financial statements, which should have been there in the financial statements, has to be covered in the MRL. And whose responsibility is that? It's the responsibility of the management. So this needs to be signed off by the management. So will it also require any signature by the? No, not by the auditor. Why? Because it's not a document of the auditor. Who owns that? It belongs to the management. So that's why the management will sign it. Right? Clear on this? Yeah. So now it's an important information. You can say it's an important evidence, but it's not a conclusive evidence. But at the same time, in terms of its timing, when do you obtain that? Some of those factors are important. Now, what are the various elements you may get to see in this MRL? See, there are a lot of elements. As we discussed, anything around the financial statements, uh, in terms of its preparation, will definitely be included in the MRL. If there are any specific points, any important considerations, important judgments, means the significant judgment, significant estimate, should that be included? Yes, that should be included. Couple of more points are important to be understood. If let's suppose there are some uncorrected misstatements, and we are talking about the both material as well as not material misstatements. Of course, something which is above trivial. Now, because the financial statements contain those misstatements, so that's why that should also be included in the MRL. If let's suppose there are some corrected misstatements, that should also be included in the MRL, because the company will say that these are the misstatements that we have corrected post audit or during the course of audit. Understood? So it's not only about the policies and procedures, it's also about something which would have taken place during the course of audit in terms of the misstatements, which are corrected, uncorrected, which are material or immaterial. By immaterial, we are not saying that each and every small amount you'll capture. Of course, anything around the trivial we are not discussing, because that's something which will not form part of it. But anything which is above trivial has to form part of it, has to be included therein, because that's going to be an important element. That's going to be an important consideration on the part of the auditor, right? And that's something which belongs to the management in a way, you can say that. Why? Because if let's suppose management has corrected some misstatements, Financial statements include the impact of that. If let's suppose management has not corrected that and auditor is happy, why? Because that is below materiality. So that is again forming part of the financial statements. That's the basis. Okay. That's how the financial statements have been prepared. They contain those misstatements with which the management is okay and auditor is also okay. Right? Now, these are some of the points which you will generally find in the MRL. Okay. Right? Now, in relation to MRL, as we discussed, the most important concern and a very common problem which is observed happens to be around what? This consideration. Auditor will say that I have obtained the letter, I have obtained the representation, so I'm through with the audit procedure. I don't need to check anything beyond that. Or if I obtain this, I'm good to go, which is wrong. Okay. So if let's suppose you talk about the audit documentation, if you talk about the sufficiency and appropriateness of audit evidence, that will not be considered to be in place if only the MRL is obtained and the supporting audit procedures have not been performed. Clear on this? Yeah. All right. So any questions, any doubts that you may have, let's discuss that. And we'll also be picking a few questions now on the top of what we have covered so far. So let me just move on to some more questions. In the meantime, any doubts if you have? All right, so let's look at this. Okay, so let's look at this. Movefast Limited is engaged in the manufacturing of shoes and slippers located in Bahadurgarh in Haryana. So that's the nature of the business. Okay. So what is the nature of business? Manufacturing of shoes and slippers, right? Due to unprecedented rains in the area in the month of September 23, many areas of the town got inundated due to the choking of sewer systems. As a result of the above, companies' premises located in town were also affected, resulting in damage of stocks. Okay. So there is a damage to the stocks of the company. The company has lodged a claim with the insurance company for rupees 1 crore for this loss. And the same is shown as claim receivable at the end of the year. So we are looking at 23-24. So the claim is not yet settled. So it's appearing as a receivable in the books of the company. In the balance sheet, it's a receivable. Now, insurance surveyor appointed in the case submitted a report to the insurance company recommending a claim of 45 lakhs in the month of April 24. Now, subsequent to the balance sheet date. Now, this is important. There is a development. What is the development? So you can say there is a sort of approval which is in place. The company has also given its consent for that approval of the claim. So insurance company is saying 45 lakhs and Movefast Limited is also saying it's fine. And the settled amount of 45 lakhs was transferred to the bank of the company on 15th May 2024. Okay. Now again, subsequent to the balance sheet date, what do you have? Claim amounting to 45 lakhs was settled. Or you can say this claim of 1 crore got settled at 45 lakhs. Okay. So this got settled at 45 lakhs. Now, you have just finished performing substantive procedures of the company by the end of May 24. Means the audit is going on till May. So all of these events have taken place while the auditor is at the client place. Means while the audit is going on. Means the audit is not completed. And then you don't have this situation. Of course, if let's suppose it's the month of April, so that is expected. But anyways, that's the information given in the question as well. Is there any responsibility cast upon you as an auditor of the company in the above situation? So very simply, if let's suppose you come across this situation, how would you deal with this? As an auditor of the company, what is going to be the course of action on your part? Okay, yeah, so that's what you need to comment upon. That's what you need to assess. So any thoughts? Anyone? How do you deal with this? Prashant, Sachi, if you want to comment on this?
So it will be an adjusting event because the conditions existed on the date of the balance sheet
Right,
regarding the claim, because the fire took place in September, and
right,
the company had shown the receivable as on 31st March, and the auditor was performing the procedures subsequently, and the
right.
surveyor had submitted its report in the month of April, and the
Okay,
company has also given its consent. So the auditor will request the management to make adjustments to the financial statements based on this, because the
okay.
impact of these should be reflected in on the financial statements.
Hmm.
And if the management gives its consent and makes the adjustment, the
Right.
auditor will issue an unmodified opinion.
Okay.
And if the management refuses to make an adjustment to
Right.
the financial statements,
Right.
the auditor will consider the impact
Yes.
and will accordingly issue a qualified report.
Sure. Right. Very good. So now, in this case, I think this entire case scenario is all about accounting impact. And the accounting impact
Sir,
is
one
very simple.
query.
Yes.
In most of the scenarios, management might be of the opinion that they will be of the opinion that we are not going to settle it. Then, by qualifying the report is okay, or we will have to get them settled in the last financial year only. This transaction,
So, of
because they
course,
most in some limited companies who have stock registered, they will be doing this, like they will say that we can adjust it in the next financial year. It happens in the current scenario jo, if we can say regular basis pay, if we say in the organizations it happens.
no, I understood your point. So, actually, you are talking about a couple of situations.
Yes,
You are
sir.
saying that what if the management doesn't want to adjust? Number two, what if the management is not agreeing to this settlement? Yes or no? Yeah. So, what we will try to do is we'll just
Yes, sir.
break it down into three parts. Okay. And we'll just try to assess the impact of all of these three situations. Okay. Now, let's talk about the first situation that we have in the question to begin with. Now, the first situation is when the management has agreed to this settlement, right? And as regards this settlement, management has also received the amount in the bank account. So it's not only a settlement, management has also received the money. Now, in this case, the question arises that how do you do the accounting? So, first of all, what is going to be the first question? That how should this be recorded, or is this required to be recorded in the financial statements? See, management has already recorded a receivable in its financial statements. It's already appearing. Okay. But the point is, if you look at that receivable in terms of its subsequent adjustment, what should you do? You will know that this money is not going to come anymore. Why? Because you understand this has already been settled at 45 lakhs, right? So if you consider the subsequent event, so that's why what should the auditor do? Auditor should get this adjusted in the financial statements. So how will this be adjusted? So basically, this 1 crore needs to be brought down to 45 lakhs. So that's the accounting requirement that we have. Yes or no? And an appropriate disclosure for the same should also be given. So that's a very simple accounting requirement we can just make out of the given situation. Now, there again, there are two situations. One, the management is happy to do that. If the management is happy to do that, then what will the auditor do? Auditor will just check that of course, these are the facts. This is the accounting management has done, and auditor is good to go, right? Why? Because the accounting is correct. So auditor is happy. If let's suppose management is not ready to do that, let's suppose management is saying, okay, fine, but the receivable which is appearing at 1, I want to keep it as 1, and I'll adjust it later on if at all that is required to be adjusted. Means wrong accounting is there in the set of financial statements which is under audit. Now in such a case, what is the impact? 55 lakhs. Right? So now in the given question, we do not know what is the materiality. Correct? So therefore, on the basis of materiality, auditor will have to assess the implications. If this is material, then the auditor will get on to a modification. But if this is not material, there again the auditor is good to go. Right? So this is the situation that we are provided with. Now, let's suppose if you talk about second situation, let's suppose management has not agreed to the settlement. Okay, so therein you can always say it's a dispute. In such a case, this matter will become slightly complicated. Why? Because you already have this receipt of settlement. So I'm not talking about the receipt of money, I'm talking about the settlement document which the company has provided. So in that case, in a way, we are talking about a situation wherein the management will get into a litigation. Yes or no? Why? Because the management is not accepting the settlement which the company is saying that I'll do at 45. Management says no, I want 1 crore. So actually, we are talking about a litigation. So therein, the management will do the assessment. Management will give the outcome of that litigation. Means what are the chances of the management getting through? So that will require an evaluation on the part of the auditor. See, even in that case, if let's suppose management believes it will be able to, let's suppose, get through, at the max, what should they do? They should call it as a contingent asset. See, if the asset is recognized, then it is considered to be a virtual asset. Yes or no? So virtual certainty definitely is not there. So even in that case, if you look at it from the perspective of accounting requirements, the accounting standard, for the management to say that because that litigation is going on, so that's why we can recognize a receivable and thereby an income. Because if they are recording a receivable of 1 crore, or you can say an excess receivable of 55 lakh, so they are in a way also recording an income of 55 lakhs, which may be inappropriate. Yes or no? Yeah, to that extent, again, I would say the accounting treatment will not be acceptable. So there again, Similar sort of implications will have to be looked at by the auditor depending on the materiality. Okay. Yeah. Shachi, you are clear on this now? Yeah. Shachi, you are clear on this? All right. So seems you are clear. So let's look at the next one. CA Anuj is the auditor of a listed company, and he is in the midst of conducting an audit of said company for the financial year 23-24. Okay, so it's a listed company and the audit is going on. So CA Anuj is the auditor. At a meeting of the board of directors held on 17th April 24, a dividend of rupees 1 crore is proposed to equity shareholders at the rate rupees 10 per share, and such a proposal has a good chance of being approved in the AGM of the company to be held after a few months. His audit procedures are near completion. He is contemplating finalizing the audit report by 31st July. Is there any responsibility thrust upon him as an auditor of the company in the given situation? Yes. Any thoughts? Any thoughts on this? Yeah. Anyone who would like to discuss this? Your thought process in this case?
Yes, sir. Good evening, sir.
Good evening. Great. So Saminathan is discussing this. Yes, Saminathan, please go ahead.
Yes, sir. So, sir, this is as per Indian Accounting Standard 1, presentation
Right.
of the financial statement. It talks about there should be the obligation to pay at the reporting date. In
Right.
this case, actually, the dividend has been proposed after the balance sheet date.
Right.
This is a clear example that the event is occurred after the reporting date.
Right.
Hence, thereby, there is no liability exists on the company.
Okay. Okay.
Hence, however, as per the SA 560, we need to disclose this matter in the notes to account. That has to be verified by the auditors.
Right. Anyone else? Yeah. So I think it seems to be a simple sort of scenario. We are talking about the proposed dividend. Yes or no? Now, here again, actually, you are required to discuss about the accounting requirement. Largely, it's about the accounting requirement. So, how do you account for proposed dividend? So, in a way, we are talking about adjustment of the proposed dividend. See, the proposed dividend is not recognized in the financial statements of reporting year. Why? Because it's not an adjusting event. When does it get approved? When the AGM takes place. And the AGM is the date which will always arise after the approval of the financial statements. So the financial statements are already approved in the board meeting. So that's why this proposed dividend you never get to see getting recognized. But in relation to that, a disclosure should always be given. Why? Because it's an important disclosure. So in this case, what is the audit consideration? Auditor will have to get into the details of this, number one. So how will he get to know about it? He'll have to review the board minutes. Further, the company would have not recognized this, most likely, which is okay. If that is done, that's a problem, which will be a misstatement. But in relation to this, a disclosure should have been given by the company. So the auditor will have to therefore check, verify whether an appropriate disclosure for the same is given in the financial statements or not. So if that is given in the financial statements, that's perfectly all right. But if that is not included in the financial statements, that is again a misstatement. Now here again, generally you find a confusion. Why? Because when it comes to a disclosure, if it is not included, or if let's suppose it is not included in an appropriate manner, means maybe it is inadequate, explanation is not proper. So therein we need to understand some points. Let's just discuss that part with you. Okay. See, when it comes to a set of financial statements, four things are required to be covered: recognition, measurement, presentation, and disclosures. Where do you get to see this? In the accounting standards. Right. Now, can we say that part of accounting standard is mandatory and the part of the accounting standard is not mandatory? No. See, the accounting standard is mandatory in all respects. And when you say that disclosure is a part of accounting standard and the same is not included, what does it indicate? Non-compliance of accounting standard. Means an error in the financial statements. So therefore, in relation to disclosures as well, there could be a misstatement. Means disclosure deficiency is also a misstatement. The only point is we need to decide what type of misstatement is that. Means whether it is material or immaterial. The way we do it for recognition, the way we do it for measurement, the way we do it for presentation. So all of these four aspects are equally important. Yeah, so that's why this consideration that it's only a disclosure, it's only an explanation. What if that gets missed? Can that be an acceptable practice? Answer is no. That may lead to a modification. Okay. Next, let's look at this. CA Soumya is the auditor of a company. So we are having this auditor engaged in rearing of poultry birds and obtaining eggs therefrom. Company has performed very well since its incorporation in 2013. Its sales had also grown and the company had expanded its market from native northern state of promoters to far-flung areas in the eastern parts of the country. However, since the last 2 years, company's fortunes have nosedived. First, due to the effects of the pandemic, and then due to recurrent outbreaks of bird flu thrice in a span of 2 years. The company's sales have dipped from around 50 crores to 10 crores. So there is a significant decline. Yeah. Further, a major part of its livestock was also wiped off during bird flu. She is not optimistic about going concern assumption followed by the company. So you can say there are definitely some indicators around it. Okay. Management now wants to start with new batches of birds. The earlier working capital facilities of the company granted by bank have also been restructured to support the business. So there is a restructuring. Okay, so this restructuring has already taken place. She was informed that the repayments of restructured working capital term loans are to begin from ensuing year. No fresh credit facilities have been granted by the bank. Okay. Now this is important, and this repayment of restructured loans have to be made. Company also plans longer credits from the suppliers. Okay, so you mean to say the creditors. Company plans to take additional measures to prevent the safety of its livestock, including aggressive vaccination, preventing health checkup, and more frequent visits of veterinary staff. Villagers in the surrounding areas have accused the company of spreading air pollution. So that's another problem on the part of the company. The management has prepared a cash flow forecast for our examination. Now, this is a critical document, as we discussed. Discuss the approach to be adopted by the auditor in examining the going concern assumption, keeping in view this specific reference to cash flow forecast. Why? Because this is the most important part. So even if the question will not specify that, you need to understand that's the most important consideration. Yes, anyone, any thoughts if you have on this? Over to you.
So can you show the last previous page?
Yes, there we are. Yes, anyone, any thoughts?
Yes, sir. Sir, as per
So
SCI,
she will.
yes,
Okay.
Prashant, please continue.
Yeah, yeah, Prashant, please go ahead.
No, you start.
No,
So,
no,
sir,
Prashant, please
she
go ahead.
will,
Yes.
first of all, yes, sir. CA Soumya will look at the management's assumption, management's assertion of the going concern which they have done, and in
Okay.
this she will consider the uh, assumptions used by the management in preparing the cash flow statements,
Right.
specifically with regard to the also with regard to the fact that the working capital loans, no fresh credit limits have been granted by the bank. So that is one indicator of material uncertainty going concern in respect of this financial indicators.
Okay.
And the company also plans longer credit from animal feed suppliers.
Okay.
So the whole idea of the CA Soumya will revolve around the management's plans for future coverage of these sales being dipped from 50 to 10 crores
Right.
to understand the going concern assumptions,
Okay.
material uncertainty relating to the going concern assumption, whether the management's assumption is appropriate or not.
Right.
So in this aspect, the management, as per my, have not shown a complete picture that how in future they will be able to restructure,
Okay.
and in that way she will ask the management to make this disclosure And also the auditor will make a disclosure relating to the material uncertainty relating to the going concern
Okay.
para.
You mean to say that there's a material uncertainty, okay, but the going concern is a assumption is appropriate, is it? So that's the conclusion you're drawing, huh?
Yes, yes, sir. Yes.
Okay. Okay. Good. Yes. Saminathan, you would like to add here?
Yes, sir. Couple of
Yes.
items. Sir,
Yes.
as per ACF 570 going concern,
Yes.
the company, the fundamental going concern assumption, the company will continue as a foreseeable future, near foreseeable future, at
Right.
least for 12 months.
Okay.
See, in the given situation, the CA Saumya responsibility is first to get the sufficient and appropriate audit evidence to determine
Okay.
whether there is a material uncertainty exists in relating to going concern or not.
Right.
Here the situation is very clear that earlier the company 50 crore, now it's reduced to tipped to 10 crores. It's very
Right.
clear, and the livestock also wiped off during the bird flu. But
Okay.
however, the management now wanted to start with the new bad batch. But
Yes.
what is the source? Source is undoubtful, since the existing working capital is about to they restructured and able to begin that installment during the next year. What is the
Right.
source for that? And no fresh credit is also is available by the bank.
Right.
Then since the cash flow is prepared for this particular purpose, then the auditor has to evaluate the reliability, the understanding the data, and determine whether it is adequately incorporated or not, where the source of fund, how the fund is managed, and also in between what is the repayment. In this
Right.
the loan repayment rescheduled structure, what is the EMI pattern, how whether they are incorporated in the cash flow or not. And also in this case some villager has a dispute, whether that dispute is accounted or not, how. And also the vaccination and some of the maintenance activity about the bird flu, whether all these things are whether it's appropriately captured in the cash flow or not, that has to be looked into it.
Sure. Good. So now, in terms of the conclusion, what do you think as an auditor? What is going to be the final outcome in terms of your report?
So based on if everything is captured in well and good. See, actually the at least 12 months period, the foreseeable nature. If the company is able to make their own arrangement to give the effect for the shortfall, then there is no
Yes.
doubt. Then there is no issue. Then the going
Okay.
concern is expert is very clear. See,
Right.
based on the analysis of that the cash flow projection, what they have provided,
Right.
the reliability and the evaluation, based on that only the auditor can give the opinion. If it is a material material uncertainties exist, accordingly she will report it.
Great. Very good. So now, in this case, some of the procedures, I think, as you have mentioned, I think you have nicely covered, you, Prashant. The most important part is what? Cash flow projections, and which require assumptions. So that's why what will the auditor need? Auditor will also need to evaluate those assumptions. Means you'll have to do the audit of those assumptions. That's going to be the focus area. In fact, the question is also requiring you to focus upon this aspect. If you read this, it says discuss the approach to be adopted by her, keeping in view this specific reference to cash flow forecast, which anyways is going to be there on the part of the auditor. Okay, so that's one. Second, when we talk about liquidity, what do we need? Funds. So now in this case, bankers have not provided fresh credit facilities. So one of the factors to be considered. How the funds from the same would be arranged. Whether the cash flow is incorporated that part or not. Means whether the cash flow is saying that these funds will be obtained. If yes, what is the basis of doing that? because accordingly your cash flows will change. Okay. Do we have any loan sanction letters? If not, then what is the basis? So some communication might be going on, maybe some discussions are going on, some confirmations, anything which the company is able to provide. In terms of the suppliers, the longer credits which are available. So what will become the basis for that? To say that I'll get the credit and the credit will be longer is one thing, but do we have that in place? Do we have signed contracts which require that longer credit? When the company is planning for this vaccination, preventive checkup, all of these things will require a cost, significant cost. Yeah, because company is aggressively planning to do that. So there again, that will result a cash outflow. So where do we have the cash for that? To say the company will do that, but where do you get the money from? Yes or no? So some of these factors become important on the part of the auditor to look into. But as around this, if let's suppose you were to give any conclusion, so definitely if let's suppose you talk about the going concern, if the management is able to provide the appropriate answers to some of these concerns, okay, then you may always say that yes, going concern assumption seems to be appropriate. But considering the factors which are there, the situation the company is into, the material uncertainty which exists cannot be denied. Okay, so that's why MUGC, or you can say this becomes a very strong case for MUGC para to be included. There again, provided adequate disclosures are given by the company in the financial statements. Right? So let's look at this next one. CS Suraj finds that key financial ratios of a company like current ratio, debt service coverage ratio, inventory turnover ratio, trade receivable turnover ratio, they are all in red. Means off. They have deteriorated considerably during the year. Company is not able to pay its creditors on time. Company is requesting time and again to its bankers to grant additional credit facilities, but the bankers are not listening. So means company is not getting the credit facilities from the banks. So that shows the funding problem. Significant losses have been incurred due to lack of response of the company's products. So at one place you also have this loss. So cash crunch and the losses. Many products are sold at below cost price. There have been situations wherein the company is not able to pay the salaries. So when the products are sold below cost, so you are also looking at the operating margin, right? So that seems to be off. All these negative findings have led him to conclude that the use of going concern as a basis of accounting is not appropriate. So that's a severe problem. He brings this matter to the knowledge of CFO. What is the reporting duty cast upon him in such a scenario? CFO informs him that the management in turn is ready to include in the disclosures the inappropriateness of its use of going concern assumption of accounting. How should it impact the auditor's opinion in case the management itself discloses the inappropriateness of its use of going concern assumption of accounting now? Over to you. Any thoughts? Tell me. What do you do in this case? How do you deal with this? Yes, I think Prashant, you would like to add here?
So just a couple of lines that if the management itself, that CFO itself has concluded that they will include the disclosures
Yes.
regarding the inappropriate use of going concern assumption of accounting, then the
Right.
accounting itself has to change and the financial statements have to be re-prepared on the basis of their liquidation.
Right.
So mere disclosure in the use of going concern assumption is inappropriate won't help, and the accounting itself has to change and the financial statements have to be redrafted.
Sure.
So
So let's look. Yes. Yeah, please go ahead.
concluded, sir.
Sure. So let's look at this now. See, if you look at the financial statements, if the financial statements have been prepared using the going concern basis of accounting, okay, but the auditor believes that going concern basis of accounting is inappropriate. So what did we discuss? It's not only a material misstatement, it's also pervasive. Why? Because the balance sheet is gone for a toss, P&L, everything there in the financial statements, which will require only one thing, adverse opinion. Right? Remember that flowchart A, B1, B2. So this is A. In this case, if the management says, don't worry, I'll include the disclosure, does it help? Answer is no. Answer is no. Why? Because accounting is required to be done basis what? Basis that you bring the assets and liabilities to their realizable value. If the management is not doing that, but they are giving a disclosure that the going concern assumption is inappropriate, that itself is contradictory. Yes or no? Yeah. So when do you require the disclosure to be in place, which will help the auditor? When there's material uncertainty, but the going concern assumption is appropriate. So in this case, we are into a severe situation. We are not into a situation wherein the going concern assumption is appropriate. Okay. Therefore, in the given situation, even if the management discloses its use of going concern assumption of accounting is inappropriate, it doesn't help the auditor. It doesn't help the auditor. What should the management do? Two things which will help the auditor. One, they should specify that the going concern assumption is inappropriate, plus bring the assets and liabilities to their realizable value. That's when the opinion will be appropriate, otherwise not. Okay. So with this, we are through. Any questions, if you have, we can discuss. Otherwise, we can just close this session.
So one question regarding not the chapter, but how do we prepare the MCQ, sir?
See, for the MCQs, I would say once again, the best way is to, of course, get into the concept.
Yes, sir.
Yeah, because if let's suppose you have the conceptual clarity, see the good part about the MCQ is that you don't need to get into the drafting. Okay, so you don't be worrying that I'll have to quote the auditing standard, my language has to be presentable. The only thing is what you need the knowledge. Yeah, but there is a challenge in the MCQ at times. See, MCQ is not about choosing the right answer always. MCQ is also about choosing the most appropriate option at times. So at times what may happen is 2 to 3 options you may find are correct. But which one is the most appropriate? So that is something you'll only be able to choose if you have the conceptual clarity. Okay, so that's where if you let's suppose mug up some of the things, if you're just trying to cram the topic, that is where you may miss out on the MCQ particularly. Yeah, so I would say the best way is just read the concept once, try to practice those MCQs as many as possible. That will help you to a great extent on that.
From
Okay.
the BOS portal, sir? Practice from the BOS
Yeah, of
portal.
course. See, some of this material which is provided by ICAI, I would say that is more than enough.
Correct, sir. Thank you.
Yeah, sure. All right. So thanks everyone for your time today. Thanks so much. We can close this now.
Thank you, sir.
Thank you very much for the
Thank you.
wonderful explanation, sir.
Thanks so much.
Thank you, sir.
Thanks. Thank you.
This class was very good. Sir, one more thing, like when we are practicing, means I was practicing some questions, so
Right.
it is taking a little bit of more time. So how can we summarize this?
Summarize what? While you
How,
practice.
while I practice, how can I do the things in time? Because audit का paper बहुत लंबा हो जा रहा है. Means I'm not able to conclude it in 3.10 minutes.
See, there is only one way. So I think it may not appear to be easy to you. If let's suppose you are thinking that it is taking you time, that means your practice is not adequate. Okay, you will need more attempts. That's the only thing. So it's not something that if let's suppose you will do this in 2 attempts and you are finding it difficult, so in the fifth attempt it will continue to remain difficult. No, automatically you will come down. Yeah, so the only thing is you need to practice more. So I would say it's a good situation for you because you have identified your problem. See, the problem is what? When you are not able to identify the problem. If you have identified the problem, the only thing is you need to work on this. So I would say you need to practice a bit more. So maybe you can pick up this entire paper in one go, or maybe you can just break it down into pieces, try to write that as much as possible. Because generally, what do we do when we practice? So we just try to do this in an oral manner, which doesn't help always. So more and more writing practice that you do will automatically solve this problem of yours. Okay.
So can we
Sir, thank
prepare a draft of the answer, and because a rough draft in the sense some points can be jotted down and then we work around that in a rough.
Sorry, you are not audible. Your voice is breaking, Prashant.
Is it okay, sir?
No, your voice is breaking.
Okay, I'll ask in next class, sir.
Again, I can't hear you. Your voice is breaking.
Samirnathan, can you explain it to sir that I'll ask in the next class?
Okay, you're saying next class? Yeah, so next class, I think we have day after only. Wednesday, we are going to have this. No, again, I can't hear you.
We'll discuss that.
Yeah, Prashant, you may type
Yes,
in
sir.
short as otherwise. I think you can type it.
For that tomorrow, we'll ask.
No worries, no worries. Sure. All right. All right. So thanks once again for your time today. Thanks so much. Huh?
Thank you, sir. Good
you,
night,
sir.
sir.